afternoon, everyone. My name is Rain Nordi, and I'm a member of the Allan investment team. My primary role is assisting the team with environmental, social, and governance, or ESG research. I'm going to start by trying to give you some more insight into how we think about and approach ESG. Integrating ESG factors into our investment research is intrinsic to Allan Gray's investment philosophy. Why is this? Because as long-term investors, we spend a lot of time trying to understand what a company's sustainable free cash flow will be. Companies that operate unethically or fail to appropriately manage their environmental and societal externalities face a greater risk of cash flow erosion over the long term. This can manifest in multiple ways, be it regulatory fines, loss of an environmental permit or a company's social license to operate, or even reduced demand for its products due to reputational damage or simply shifting societal preferences. Because ESG can be material to a company's investment case, our investment analysts are responsible for researching ESG in relation to the stocks they cover. We also have 3 full-time ESG analysts, myself included, assisting the team with monitoring as well as thematic and company-specific detailed research. Every company research report we write includes an ESG section, and when material, we try to quantify these ESG risks or opportunities in our fundamental valuations. We may also choose to limit the size of our holding in a company or not invest at all, where we think the ESG risks are substantial and not adequately mitigated. We further integrate ESG into our engagement with company management and boards, and by making carefully considered proxy voting recommendations to our clients. Our portfolio managers are ultimately responsible for managing the ESG risks in our clients' portfolios, but we also report to our board of directors biannually, who provide additional oversight. At Allan Gray, we pay particularly close attention to the governance element within ESG, and the reason for this is because as shareholders on behalf of our clients, we are not involved in the day-to-day running of companies, and so we must place reliance on management and boards to act responsibly. We assess how well management is aligned with long-term shareholder interests by evaluating how they are incentivized through their executive remuneration schemes. And then we also try to assess the effectiveness and independence of the board in terms of how they are able to provide oversight. Lastly, studies show that stronger governance is generally associated with stronger company environmental and social performance as well. It's fair to say that ESG has taken the investment industry by storm over the past few years and become very topical. And with this, we see new benefits and challenges. To me, the biggest positive is that globally, investors are thinking more critically about the environmental and social impacts of companies in which they invest. Companies' externalities feed into global problems, such as climate change, biodiversity loss, and social inequalities. And these are hugely complex and multifaceted. So the more attention there is on addressing them, the better. I really do believe that companies being asked critical ESG questions by investors and having investors follow up on progress leads to a greater prioritization of ESG at the issuer or underlying company level. We see this in companies increasingly promoting sustainability teams and appointing new sustainability officers. With that said, as an investment industry, we must also be honest about what we are and what we are not. For example, we are not experienced policymakers. Many of these problems are really complex, and in my view, they require effective and coherent policy and regulatory development and enforcement far above investor engagement to be effectively addressed. This would also avoid unintended consequences. An example here is asset owners increasingly announcing divestments from fossil fuels and particularly thermal coal. Now, what happens here is that listed companies are rushing to unbundle or privatize these assets, but once sold, they remain in operation and in fact often increase production. The climate is no better off, while lesser disclosure requirements mean that society generally has less insight into these companies and their site management than before. Despite not agreeing with all ESG solutions offered within the industry so far, we must still think of the many ways in which ESG as a growing global theme could impact future stock picking and our clients' investment portfolios. Now, there are 2 layers to this. So at the first level, we must think about the ways in which it could affect issuers or the underlying companies. Examples here include considering how an accelerated global energy transition could impact the demand for metals in the future, whether lower carbon commodity producers within a sector will attract higher prices for their greener commodities, or whether single-use plastic bans throughout the world how they will affect oil demand and the packaging industries. Secondly, at an investment level, we must consider how this ESG theme could affect investment flows. For example, the Net Zero Asset Managers Initiative was recently launched to spur the investment industry to commit to net zero emission portfolios by 2050. Now, what this means is that the flows into low and high emitting sectors going forward will be impacted, and even flows within sectors as some companies emerge as low carbon leaders. In other words, we must try to think how investors will place value on various stocks and sectors in the future. On the other hand, at Allan Gray, we are bottom-up stock pickers, and we do not believe in entirely avoiding high-emitting or hard-to-abate sectors. These can still be good investments if the share price is more depressed than we think the risks warrant, and our research suggests that the company is taking responsible steps to improve and ensure its sustainability. Now moving on to some of the challenges that we face in the industry, I think the first is that particularly in less developed stock markets, companies reporting on ESG issues is still quite light in some cases and inconsistent. And this makes meaningful evaluation and comparability difficult. How we're trying to address this at Allan Gray is by engaging with issuers on a case-by-case basis to improve their disclosures. And we also ensure we don't only rely on company reporting. So we look to multiple sources for research, which includes NGO, academic, regulatory, and other news reports. A second challenge is that because of how complicated and nuanced these issues can be, there are wide interpretations of how companies are performing. The world now has over 130 data and ratings providers assessing companies' ESG performance. The PRI looked at the pairwise correlations between 6 of these top providers and found low and even extremely low correlations between them, which shows how subjective these assessments can be. With individuals, I think this is often further complicated by the fact that we tend to view ESG issues through the lens of our own personal value set. And this means that for Allan Gray, we can find it difficult to meet all our clients' expectations. The EU is leading the way on regulation trying to address some of these interpretation challenges, and regulators elsewhere in the world, including South Africa, are watching closely. In terms of the role we try to play, we are trying to participate in industry initiatives that promote more regulatory clarity on ESG. So, for example, we have provided detailed feedback on National Treasury's draft Green Finance Taxonomy or the revised CRISA Code earlier in the year. In closing, I think going forward we're going to see a challenge on the horizon of the intersection of environmental and social factors. To date, environmental considerations have been in the driving seat, but the COVID pandemic has further accentuated deep inequalities in many countries, and this has potentially severe consequences, as we have seen in South Africa with the recent riots and looting. In my view, ignoring the social aspect in ESG is as much of a global risk going forward as ignoring the environmental issues, such as climate change. And I think the social pillar will gain prominence in the coming years, and is something that we're focusing our minds on at Allan Gray. Thank you so much for your time, and we hope you have found this useful.
My name is Ndabe Mkhize. I'm Chief Investment Officer of the Eskom Pension and Provident Fund, EPPF. It is the second largest pension fund in South Africa, with more than 80,000 members and more than 170 billion rands in assets under management. We take responsible investing seriously. And for us, responsible investing encompasses 3 things, which are ESG, environmental, social, and governance factors, impact investing, and transformation. We believe that they're all related and can really be put under the various aspects of the environment, the social factors, as well as governance factors. Under the environmental factors, there are issues pertaining to climate and disclosure or reporting on the impact of the fund or the impact of the investee companies on the climate. The challenges and issues that we encounter there tend to be issues of just transition. Do you really turn off your polluting industries immediately and without notice, or do you give people a bit more time to transition out of those investments? We also have issues of social factors, which could be the gender pay gap. It could be issues of employment equity and transformation, which is very important in South Africa, as well as governance, which speak to stewardship, the protection of the investor rights, and all things that are related to that. There are a number of challenges that we see when it comes to ESG. Firstly, some managers pay lip service to it. And we are speaking here as mandate makers, not those who draft policies as opposed to those who are implementing. But what we feel and our challenges when it comes to the implementation of that policy is that some other asset managers don't believe in it. They believe that if they do financial returns very well, as what was happening 5 years or 10 years ago, that's all that matters, and they would have delivered and have taken care of their clients and their pensioners. We'll have those who actually do appear to be embracing it, but don't go holistically, don't go all the way, do not integrate it into their investment processes, into the way they would value and assess the viability of a company. And those who don't take it into account when engaging with management. We also have problems with others who rely on scores of the various ESG rating agencies without doing anything themselves. We believe that those problems are solved by thorough due diligence. When selecting managers, we take into account how they integrate ESG holistically and look at those who are serious about it. And in our view, in a few years' time, those who do not take ESG seriously will basically render themselves irrelevant to asset owners. We've seen the issues of the environment and social factors taking center stage. In South Africa, we believe that the issues of a social nature are even more important and near a clear and present danger, as we saw in July with the riots. So when the society is not taken care of, it does not matter how good the environment you have, you will have problems. On the other hand, having good people who are taken care of where there's pollution is also not sustainable. So both of those factors need to be taken into account. And I can safely say that as an asset owner, our pensioners want to make enough money to retire on. So they do want that financial return, very much so. But they also want to live in a sustainable world that they can retire into and not have to be worried about whether the air is of high quality or whether there's enough, whether there's bread in the shopping malls for them to be able to buy food. So we believe that those issues can coexist, and any dichotomy is a false dichotomy. They should be integrated in a coherent manner. Thank you.
Good afternoon. My name is Ben Preston. I'm here representing Orbis, where I'm one of the co-managers of our global equity strategy and a board member of Orbis Holdings Limited. It's a real privilege to talk to you today about responsible investing, a subject that's not only dear to my own heart, but critically important for us to get right as an industry. I think we're still collectively at a very early stage of figuring it all out. So what I'd like to talk about today, first of all, what is responsible investing? What does it mean? Secondly, what's our approach? And then thirdly, what are some of the challenges we face at Orbis and as an industry to get this right? So first, the definition. The United Nations PRI defines responsible investment as a strategy and practice to incorporate ESG factors in investment decisions and active ownership. So it's not thou shalt not own fossil fuels. It's a strategy and a practice to incorporate. And I think the way that's worded is deliberate and sensible. And it's consistent with our own beliefs, our own philosophy, and our own approach. Bottom-up analysis is what we do. We already incorporate all relevant factors that we can think of when we're analyzing and valuing companies. So on one hand, you could say, well, this is what we've always done. But at the same time, ESG is becoming an increasingly important factor to consider in our assessment of a company's fair value. And if we are to play to our strengths in bottom-up fundamental research, and if we're going to deliver on our mission, not only to generate great investment results, but to do so responsibly, then ESG is something we have got to do a great job of. So secondly, what is our approach on this? Well, we've got three key principles. Integrate thoughtfully, engage proactively, and reject judiciously. So I'll start with integrate thoughtfully. So we believe strongly that ESG analysis has to be a central part of company analysis, not a separate function, not an afterthought. So we include an ESG section in all of our phase 3 research reports, and it's not a tick box exercise. ESG is complex. It requires judgment, just like other parts of our investment research, actually. For instance, in the case of an energy company, we factor in the implications of an energy transition towards renewable power sources. So for some companies, that might be a negative, might be a headwind. For example, the extra costs incurred by a fossil fuel company to improve its practices and comply with regulations, or it can be a positive. For example, we own shares in Vestas, a wind turbine company where we believe the future is bright. But either way, our aim is to integrate. Secondly, to engage proactively. We prefer engaging to divesting. Solving problems comes from engaging with them, not just passing them on to somebody else. And that's great because it's also a win for our clients. If we can help a company improve its practices, that's good for the world, but it's also good for our clients because it's a positive for valuation. And then thirdly, reject judiciously. There's some companies that we wouldn't be willing to own at any price, and we are ready to reject them on ESG grounds. So this is not about broad brush exclusions, it's company specific. So typically, this will be for situations where companies are operating in ways that don't feel right to us and where we believe engagement would not be successful. In those situations, the responsible thing to do, in our view, is to walk away, and we'll do that. So those are our principles: integrate thoughtfully, engage proactively, and reject judiciously. And the third part of what I'd like to talk about today is challenges ahead. What are the challenges that we all, as investors, face regarding ESG? There are many, but I'll mention two. First, how to cut through all of the noise on ESG and all of the data without separating it from the investment decision. It's a challenge because to do a great job on ESG analysis requires specialist skills, time and effort. So do you have an investment person doing ESG, or do you have an ESG person doing investment? The challenge really is to how to bring those skills together. And the second challenge, the bigger challenge if you like, is how as an industry we can actually make a difference. Take the example of climate change. To really make a difference as stewards of our clients' capital, we're going to need to do something more than just setting a net zero carbon target and then shuffling our portfolios to tick that box. That's like addressing your children's naughty behavior by swapping them for the better behaved kids at the front of the class. You can't solve the world's problems by just passing the hot potato onto the next owner. It might be good PR for a portfolio manager to have a net zero target, but if all that means is selling a coal mine to somebody else and buying a vegetarian meat company from somebody else, it hasn't made the blindest bit of difference. The coal mine still exists. The veggie burger company hasn't sold any more veggie burgers. If we as investors all want to own the same companies, we'll just end up bidding up their share prices to a point where they offer investors no return whatsoever. And that can't be the answer. As an industry, we're going to have to learn how to become more effective stewards, working with companies, with regulatory bodies, engaging to create solutions that deliver results for both investors and for wider society. That's the big prize.
My name is Graham Sinclair. I'm ESG architect at Cinco. I teach at Villanova University and Harvard University, and am a host of the new podcast ESG and Coffee, which looks at investment strategy and sustainability in long-form interviews with investors. The team at Allan Gray and Orbis have asked me to offer some insight into environmental, social, and governance factors in investment. Well, ESG, environment, social, and governance factors, are implicit in every investment decision. ESG is a discipline. It's not a strategy. It's not an asset class. It's not a theme. It's a discipline. And that's because ESG is in every investment decision on planet Earth that relies on humans to make, do, or buy stuff, and on the rule of law to protect minority investors and the relationships between businesses and between investors and the businesses that they own. The key push is to look at improving the ESG positive factors and reducing the ESG negative factors. We're at the stage now of looking at improved regulations demanding that companies and investors in companies in any asset class look more closely at the ESG factors and look to maximize the positive. Examples would be looking at environmental performance, waste and effluent, looking at climate change impacts, looking at social aspects like how employees are treated or the quality of the workforce and the supply chain, or the relationship between the consumers of the product and the company. And in governance, looking at elements like executive pay, the independence of committees and the board, and looking at the chairman and CEO relationship, for example. All of these ESG factors are part of fundamental analysis and making investment decisions. In the past, it was too easy to ignore them or complain it was too hard or the data was not readily available. Well, the key insight I'd offer firstly is that data has never been more available. Every platform, every software vendor is looking to deliver more ESG factors. And now even looking at things like artificial intelligence and machine learning to track, for example, sentiment analysis, or look across different reporting frameworks for any kind of ESG signal that can be picked up to improve the quality of the investment decision. We're also seeing more companies, oftentimes ahead of investors, looking to promote what they're doing and putting their best foot forward to try and share the environmental, social, and governance performance that the company has achieved in front of investors, looking to improve the quality of that investment relationship, or convince the investors that they're a better quality management team, or they better understand a changing marketplace and so have better prospects in that particular marketplace. Some of that is also driven by regulation of the company and or the investor. We're seeing more expectation and more regulation for companies to be reporting on their water footprints or their carbon footprints, or what is the diversity profile like in the portfolio, in the employees that they have. We're also seeing more focus on investors. In Europe, we've got the categorization on what kind of investment fund are you running. Is it ordinary or conventional, or is it light green or dark green? How explicit are the objectives of the fund in terms of environmental, social, and governance factors? And now, even in the US, the most interesting news is the Securities and Exchange Commission has firstly approved the decision from NASDAQ to require more diversity from the companies that they list. And in some ways, that's reflected also in Goldman Sachs refusing to IPO any company that doesn't meet certain minimum diversity thresholds. As well as the SEC is now shortly, I would say in Q4 of 2021, coming forward with a proposed new ruling on how companies need to report on climate issues, probably using the Task Force for Climate-Related Financial Disclosures as a methodology, and probably adapting some of the work of the Sustainability Accounting Standards Board. So as there's more data available and more expectation that investors are looking to make investment decisions integrating all factors, including environmental, social, and governance factors, well, the question becomes, well, what are you doing as Ms. or Mr. Institutional Investor, and what have you been doing for the last decade? South Africa has been very well placed, as well as some other jurisdictions like New Zealand or Denmark, United Kingdom, the Netherlands, even parts of the US and Canada. South Africa has, since 2013, has had world-leading pension fund regulation in terms of Regulation 28 and how it frames environmental, social, and governance factors. We've had the King Code, we've had the Code for Responsible Investment in South Africa, but still very slow in the Southern African context to see enough environmental, social, and governance factors really weighing into the investment decisions. And let me end and offer the most pointed insight, if you will, that really is in your hands. If you are looking at the data, and I encourage you to, and if you are speaking to client scientists, and I hope you have one informing the decisions you're making at a board level, and indeed that you might expect your investment managers to be hiring, you know that things are looking pretty bad. The IPCC's report is titled Code Red. It doesn't get more plain than that we have a situation of a changing climate. Humans literally have caused the geologic age to be renamed the Anthropocene from the Holocene. And in this situation, you're expected to make long-term investment decisions, looking at the forward prospects of a company and rolling that back to today to weigh the benefits of company A versus B versus C. Well, I strongly encourage you to look at doing that by integrating all factors, including environmental, social, and governance factors, and specifically where you are long-term investors, or perhaps where you have a smaller market like you would in listed equities in South Africa, but in any country, in any jurisdiction. As a universal owner, you have a stake in the whole economic system and the society within which that economy succeeds or fails. And so as a universal owner, you have a piece of that whole pie. You can't simply trade out for a different planet. You can't simply trade out for a different society. So it really is in your hands. The investments you make become the world we live in. So I'd like you to accept this challenge. Be the Cheslin Colby, don't be the Owen Farrell. And I think you can do this. I look forward to finding out in the coming years what you've achieved with the team at Orbis and Allan Gray. Thank you.